You open your wallet, or maybe you check your banking app, and you see a number that feels solid, concrete, almost sacred, a figure that represents your freedom, your choices, your life. And yet almost immediately that sense of ownership dissolves the moment you stop and think, because those numbers are not really yours, not fully, not in any way that is obvious, and certainly not in any way you were ever asked to agree to. And that is the uncomfortable truth at the heart of modern finance. That the money you hold, the balances you check, the credit cards you swipe, are all part of a vast, invisible system that moves faster than you can comprehend. A network of obligations, promises, and power flows that dictate not just what you can spend, but also who holds sway over your life, over your opportunities, over your very ability to act. And if you have never stopped to consider how the banking system, credit systems, and the complex mechanisms of money creation operate, now is the moment, because understanding this is not just academic curiosity. It is survival in a world where your choices are mediated by algorithms, interest rates, and institutional incentives that rarely align with your own, where the very concept of having money is a performance, a carefully managed illusion. Because the truth is that the money in your account exists primarily because someone somewhere decided to trust it, to allow it, to recognize it, and that decision is embedded in layers of agreements, contracts, and credit chains that stretch back decades, centuries even, yet have evolved in ways most people never notice. So let's start at the beginning, not the history of coins or notes, but with the moment when a bank, or more accurately, a modern financial institution, creates money out of thin air, which sounds like an exaggeration, and yet it is precisely how the system works. When you deposit your paycheck, the bank does not simply put those bills on a shelf and say they belong to you. Instead, it records your deposit digitally and then leverages that number to extend loans, mortgages, and lines of credit to other customers. A process called fractional reserve banking, which is deceptively simple in concept but profoundly powerful because it allows a single unit of currency to be counted multiple times across the economy, enabling expansion, but also concentration of influence. And this is where power begins to flow invisibly through your wallet, because every time a bank lends, it is effectively creating new money, new obligations, new debts. And with that creation comes the invisible hand of incentive, where banks are rewarded for lending, for risk-taking, for multiplying numbers on screens that only superficially appear like assets, but in reality are claims on future labor, future productivity, claims on your capacity to earn and repay. And most people never pause to consider that every dollar in your account is simultaneously a promise, a liability, and a lever, a mechanism that can be pushed or pulled by actors far more powerful than yourself. And yet we treat it as mundane, as normal, as if simply swiping a card or transferring funds is an act of autonomy, when in fact it is participation in a carefully calibrated network of credit and control. And this network has rules that are largely invisible to you, rules that govern interest accrual, late fees, credit scores, and even the implicit trustworthiness that underpins your financial identity. And these rules are designed not to be obvious, because opacity is a form of power. Because if you fully understood the mechanisms by which your spending, your saving, and your borrowing are mediated, you might resist, you might question, you might withhold. And yet the system depends on your ignorance, on your assumption that the money you see is entirely yours, unencumbered, a resource you command freely. And the first revelation is that this assumption is profoundly false, that the numbers in your bank account, while accessible, are contingent on a network of interbank settlements, regulatory oversight, risk assessments, and the broader macroeconomic environment, all of which can shift suddenly, invisibly, in ways that affect your life in dramatic fashion. Which brings us to the next layer. Credit scoring, a mechanism that converts your history, your behavior, even your assumptions about the future, into a single number that dictates access, opportunity, and cost, where a few digits on a report determine the interest rate you pay, the houses you can rent, the cards you can open, and ultimately your freedom within a society that claims to be free. And the irony is subtle but pervasive, because while the rhetoric around credit often emphasizes responsibility, self-discipline, and empowerment, the underlying reality is that the system is designed to optimize for institutional profit, to reward lending activity and default management, to balance risk and return in ways that rarely align with individual well-being. And yet most people internalize credit as personal virtue or vice, as if your worth is measured by your compliance with an artificial, algorithmic judgment. And this is where the tension sharpens, because it's not merely about numbers, but about control, about who wields leverage in society, about how money, which is supposed to facilitate life, becomes a tool for shaping behavior, aligning incentives, and concentrating influence. And as we explore this further, we see that credit is not just a function of lending, it is also a function of time, because interest is the mechanism by which the present is extracted from the future, a way of monetizing expectation, a silent siphon that transforms potential into revenue, that transforms your projected labor into someone else's gain. And this mechanism is subtle, because it works on incentives rather than force, on compliance rather than coercion, on perception rather than reality, and yet it is mathematically inevitable, because when a bank lends $10,000 at a 5% interest rate, and that money circulates and multiplies, the cumulative effect over years, decades, or generations is staggering, producing wealth in some places, scarcity in others, and a hierarchy of power that is rarely visible, rarely questioned, and almost never intuitive. And this is why understanding credit is crucial, because the decisions you make about borrowing, spending, or saving are not merely personal. They are embedded in a system that can amplify small choices into life-altering consequences, where the rhythm of payments, defaults, and repayments forms an undercurrent that shapes markets, shapes behavior, and shapes society itself. And yet the general public remains focused on headlines, interest rates, or anecdotal stories, rarely pausing to consider the hidden arithmetic, the incentives, the flows, the chains of cause and effect that render a seemingly simple transaction into a node in a vast, interconnected network of economic power. And to make this concrete, consider a mortgage. You borrow a few $100,000 to buy a house, and over 30 years, you repay more than double the original amount, an arrangement that seems reasonable, even normal, even fair, yet in that repayment structure lies a quiet irony, because the lender profits most when you are slow to pay, when you are managing, juggling, leveraging, and delaying, when the system extracts as much from your future as possible while you believe you are responsibly managing your present. And this pattern repeats across credit cards, auto loans, student loans, and corporate debt, producing a web of obligations where most people are functionally tethered to institutions that profit from their continued participation. And yet the narrative you are sold emphasizes freedom, flexibility, opportunity, entrepreneurship, choice, and it is here that the contrast between public hype and underlying reality becomes most stark, because while headlines boast about low interest rates, financial literacy, and accessible credit, the underlying mechanisms ensure that power remains concentrated, risk is socialized in some contexts and privatized in others, and the average consumer is rarely in a position to benefit disproportionately, because the system is calibrated to extract value gradually, invisibly, and continuously, which leads to uncomfortable math. Consider leverage ratios, reserve requirements, and the multiplier effect. Consider the fact that the amount of money created via loans is often many times larger than the physical currency in circulation. Consider that your deposits are simultaneously someone else's liability and someone else's asset. A fact that is simple to state, but mind-bending to fully internalize, because it implies that the apparent solidity of your wealth is built on layers of mutual dependency, trust, and mathematical inevitability, and that any perturbation in these layers, a bank default, a sudden liquidity crisis, a regulatory change, can ripple through the system in ways that directly affect you, even if you have done nothing wrong, even if you have acted with perfect prudence, which underscores the hidden fragility of the entire network and the quiet absurdity of treating personal finance as entirely under individual control. And yet most people never pause to consider this, because the narrative they internalize emphasizes responsibility over structure, choice over contingency, agency over systems. And this is why storytelling is essential here, because numbers alone are insufficient to convey the stakes, the flow of power, the tension between perception and reality, the incentives baked into every transaction. And as we widen the lens, we see that credit systems are not isolated phenomena, but integral components of macroeconomics, of governmental policy, of global financial architecture, where central banks, regulatory frameworks, and international capital flows interact with local banking behavior to produce outcomes that are often predictable mathematically, yet counterintuitive socially, producing cycles of boom and bust, bubbles and crashes, crises and recoveries. And yet the general narrative remains anchored to optimism, self-improvement, and personal choice, masking the structural forces at play, masking the way in which the system leverages human behavior, timing, psychology, and incentives to reproduce wealth hierarchies over time. And so the deeper revelation is this. When you interact with money, when you swipe a card, when you sign a loan, when you check your balance, you are participating in a mechanism designed not to empower you fully, but to manage, guide, and extract value from your future labor. And if you step back, the pattern is both elegant and unsettling, because the system works, it is efficient, it generates growth, liquidity, and opportunity, yet it also concentrates power, shapes behavior, and enforces a quiet hierarchy, a hierarchy that is mathematical, not merely social. And that is why understanding credit is both liberating and disquieting, because clarity reveals that autonomy is conditional, that freedom is structured, that wealth is not merely earned but mediated, and when we explore the long-term implications, we see that reliance on credit systems introduces systemic risk, moral hazard, and intergenerational obligations, because the expansion of debt, the multiplication of credit instruments, and the compounding of interest rates create exponential growth that cannot continue indefinitely without periodic correction, crisis, or recalibration. And yet society treats this growth as normal, inevitable, desirable, because the benefits of expansion are visible while the costs are diffuse, delayed, or hidden, which means most participants are blind to the long-term consequences, even as they rely upon the system daily, a dependence that is both practical and perilous, because a sudden change, interest rate spikes, policy shifts, inflation defaults, can destabilize individuals, families, communities, and markets, and all of this is operating while the narrative of personal responsibility, opportunity, and financial literacy quietly misdirects attention from the structural reality. The invisible power flows, the mathematical inevitabilities, the network of obligations that govern not just the economy, but the texture of daily life, the timing of payments, the choices available for work, education, and consumption, and the psychological pressures that arise when one realizes that the numbers in a bank account are both your tool and someone else's asset, a duality that is ironic, subtle, and slightly absurd. Because while the system promises freedom, liquidity, and empowerment, it functions primarily through obligation, leverage, and control, and yet it is not malevolent, it is merely efficient, logical, optimized for profit and stability in aggregate, which is why most people are blindsided, because the system does not fail in spectacular ways often. It fails incrementally, subtly, through delayed payments, credit score impacts, interest accumulation, and network effects, until the cumulative consequences become unavoidable, visible, and often devastating. And this is the uncomfortable truth. Understanding the system does not make it more generous, it does not give you more control, it only gives you the ability to navigate it with awareness, to see the incentives, to trace the flows, to predict the pressures, and to recognize the irony that the very money you assume is yours is a tool, a lever, a promise, a liability, a network of trust, and a mechanism of control, all at once. And from this vantage, every purchase, every debt, every payment, every swipe of a card, every click in a banking app becomes a narrative, a story in which you are both actor and subject, empowered yet constrained, aware yet still part of a larger machine. And as we close, we confront the final unsettling insight. The system is vast, resilient, efficient, and opaque, and while you may understand it intellectually, while you may navigate it skillfully, it remains fundamentally beyond your control, a structure designed to function whether or not you comprehend it, a network of power that flows invisibly, continuously, and inevitably through your wallet, shaping your life in ways that are quiet, cumulative, and unavoidable. And the question that lingers unresolved is not how to master the system, but how to live within it, with awareness, without illusion, understanding that your freedom, your money, and your choices are real, yet mediated, leveraged, and profoundly entwined in a larger architecture that is both functional and indifferent to your desires.